Hi everyone, I'm often asked by people for higher reward strategies. Well, of course, everybody wants a higher reward strategy. It usually means higher risk. So how can we go about that? Okay, I've got a really special video for you. I put a lot of thought into it for you because it's part of what I do, but it's not something I've shared before. Okay, let's say you want to add more risk. For more return, okay, nobody thinks in terms of adding risk, but that's what you're doing when you're getting more return to your portfolio. Let's say you've got $20,000, change it into pounds if you need to, $20,000 risk capital for higher risk returns, okay? That's aside from what you might have for your safer pension, your children's ISA, and your rainy day investments. This is purely the risk capital. Now here's some do's and don'ts. First, do not over leverage on a spread bet. That's how the housing market happened. What I mean by over leverage is imagine you bought a house and imagine you've borrowed so much money that you can barely make the mortgage payments. And let's say interest rates go up. All right. Then you're trapped and housing prices fall. Then you're in negative equity and you can't make the monthly payments. Okay. That's what over leverage is. It's what a lack of liquidity or cash flow is. What's the equivalent in share investing? I'll explain that. Do pick safe stocks if you're going to do the strategy I'm going to describe. And by safe, I mean Microsoft. Why is it safe? I'll explain why in a second. And do know the risks, which means look at the maths that I'm about to show you. This is the last 2 years of Microsoft returns. Over a 250-day period, they've generally, these are the days in which they've generated different returns. Okay, and there you go. So that's the risk return and the return histogram, as it were, of Microsoft over a 250-day period. There are 250-day periods where it's generated 80%. There are 250-day periods where it's only generated up 13%. And that's based on its returns over taking sample data over a couple of years. Okay? So over a 250-day period, there have been times when it's been up 80%. And there have been times when it's only been up 13%. Okay? On a one-day basis, on the whole, it's up somewhere between 15% to minus 15%, but most of the time on a one-day basis, it's barely moved. Okay, now that's fine. History's no guarantee, so we don't want to look at just the last 2 years worth of data and give an idea of what kind of ranges that might give us. Let's look at a bigger sample data. There's a 95% probability on data based on what's called a log normal random walk, okay, based on historical data, that it could, given where it is today, at the time of me doing this video, that it could be down 28% or over 179%. In other words, there's a 95% probability it's going to be between those two ranges, and a 5% probability it's going to be worse than 28% down and over 180% up. Okay, so that gives you a good idea of the kind of ranges that something's in. When you buy a house or you might be in business and you borrow money, you're pretty much doing the same calculations. You're saying there's a 95% probability this is what will happen in the market. If we get outliers, hey, we go bankrupt. That's usually how people make decisions. So let's just take the outlier first of all. The worst case scenario, according to historical data, is that there is a probability, a small one, that we could be down less than 28%. Okay, let's just look at that in more detail. Let's assume, right, that we're going to plan for a whole 5% probability of being below 28% or above 178%. That's what it says. Actually, let's be safer than that. Let's assume there's a 5% chance of being down 30%. Okay, we know we're in the rough ballpark. Now you might say, no, Alpesh, there's only a 2.5% probability we'll be down less than 28% or such. No, let's be really conservative. Now, if we used a leveraged product like a CFD or a spread bet and bought the equivalent of 300 shares in Microsoft, which is $209 per share at the time of speaking, then that's $62,750,000 worth of shares. Okay, we would control. In fact, if we didn't even use a CFD or a spread bet, we just bought the actual shares, right? That would be $62,757 worth of shares we'd control, right? If it dropped 30%, i.e. 30% of that, you would use up about $19,000 of your risk capital, which is pretty much all your risk capital, if it did indeed drop that 30%. And we said there's a 5% probability of that happening, which you might think is negligible. Now, you don't have $62,757 to buy those shares in the first place. You've got $20,000. So how do you do it? Okay, Well, the reason people buy houses on mortgage is because they believe there's a skewed probability, just like with Microsoft shares, that they will rise, and a very slim probability that interest rates will go up, that they can't afford the mortgage payments, and that the price will fall and they'll be stuck in negative equity. Similarly, we might consider Microsoft, given this data that we've got, to be similar to that. If that's the case, we'll plan, as I said, for a 5% probability of being below 28% or above 178%, as I said. Now, if we used a leverage product like a CFD or spread bet and bought the equivalent of 300 shares in Microsoft, and you can see a deal ticket on a typical broker here, 300 shares, 62,000 notional, that means as if we were buying the underlying, okay, we would need a deposit or margin. You can see the figure, whoops, let me move myself down here, the margin or a deposit. Just like when you're buying a house, you put a 5% deposit down, don't you? You don't put down, if you're buying £1 million house, you don't put £1 million down. You might be asked to put down £100,000. Okay, so it's the same principle with shares, right? Now, we'd need a deposit of margin according to this broker. Different brokers have different requirements. 2,822 with the broker. Plus, of course, over the course of the year, funding charges to borrow the other money. The difference between the margin and the notional, because we're borrowing that from somewhere in order to own the shares, and we're borrowing it from the broker, and the broker will be able to tell you what the charges might be over the course of a year. Now, if Microsoft does indeed go up, let's say $50 on its share price, which was at 209, i.e. it goes up 25%, because $50 out of 209 is roughly 25% per share, we make $15,000. Why? Well, 50 times 300 is 15,000, i.e. 75% on our risk capital of $20,000. So we made 75% on our risk capital of $20,000. Now you might say, well, wait a minute, I'm not going to measure it against our risk capital of $20,000. I'm going to measure that $15,000 against this $2,800. That's even bigger. Yes, it is. Don't get carried away though. Okay, use it on your actual risk capital. That's why people who spread bet lose money. They lose money because what they do is they get greedy. They look at the wrong numbers than the right ones. Now, if it drops, and this is more important, if it drops 30%, you're out of pocket $19,000. How do I know that? Well, because 30% of $209 per share would mean you'd be down at $19,000. All right, that's pretty much your risk capital, as I said. So what do we do? Well, what are the risks? I mean, now some of you might say, well, this is fantastic, Alpesh. I've got my risk capital. I can use it for a bit more zip than just buying $20,000 worth of shares. I'll be buying $62,000 worth. And I know there's a risk I could lose it all, but that's only 5%. And I know that if it rises 25%, which, guess what? Very often, statistically, we know over a 250 day period, it actually rises about 46%, not just 25%. So it rises almost double that. So Alpesh, you're being very pessimistic on this and risk averse, and that's the way to be anyway. So what are the risks? Why should we not do this? Well, here are some of the risks. You lose all your risk capital very quickly as Microsoft drops. That's the risk. There could be a flash crash. It could drop 50%. It drops more than 30%. You're liable to more than your entire risk capital because you didn't have time to exit. You lost all your money, or you thought, oh my God, this small probability is actually happening now. That's how hedge funds go bust, because small probabilities happen. That's how banking crises happen. Okay, that small outlier actually happens. You get your calculations wrong. There was a bit of complex mathematics there. You might get it wrong. You don't account for broker interest charges. Speak to your broker what they might be. Your broker is not regulated properly or trustworthy. They're located out of Cyprus. You know, this is for sophisticated high-risk investors. Only risk of losing more than your initial deposit is a possibility and probability. Got it? What this does is show you what might well happen on the upside and the downside, and why so many people lose money with spread bets, because they get the maths wrong, they look at the wrong numbers, they look at the wrong figures. So what are the numbers, by the way? For Apple, let's say Apple, well, there's a 95% probability that it could drop more than 30.5%. Okay, 30.5%, 95% range of being between those two numbers, right? 95% probability, this is down between 41% and up 156. So I'm going to assume the whole 5% probability of dropping 40%. Okay, Alphabet, the whole 5% I'll assume of dropping another 40% on that worst case scenario. So we take the worst case scenarios and develop our trading bet, let me put it that way, accordingly. 5% probability that in a year it's down 40%, right? So I've done some maths for you there and you've seen the figures. Beware of the risks, but I hope you found this useful. I'm looking at it over a 12-month period, not over shorter term periods. And hopefully you'll understand how leverage has been used in the housing market. Also, more importantly, what's led to some big blow-ups. People don't understand leverage. They take too much risk. They don't actually have hard numbers and hard data like we've done. Hope you found that useful. Thank you very much.